Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in TradFi, digital assets, technology, and financial planning. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site is Chris Dearborn, Managing Director on Nasdaq's Market Intelligence Desk, Marvin Loh, Senior Global Strategist at State Street, and Eric Winograd, Chief U.S. Economist of Bernstein. They join us to discuss the strength of the economy and the Fed, what its expectations are, and if we will start to cut rates in 2024. And gentlemen, that really is the question. Eric, at the beginning of the year, the market was pricing in 6 to 7 rate cuts, and lo and behold, here we are hitting all-time highs virtually every other week.
Yeah, look, it's a reminder that looking forward is a dangerous business. And, in Q4, when the inflation data were printing in a positive way, the market looked forward and thought that it would continue in a straight line and priced an aggressive path for rates. Obviously, we've hit a bump in the road in the first quarter. Inflation hasn't been falling as quickly, and as a result, we're pricing what I think is a much more realistic scenario. We're still talking about 3 rate cuts this year, which we do think will be delivered. But it is impressive that equity markets have powered through, even with more limited expectations of easing and even with longer dated bond yields rising.
Yeah, I mean, to me, I think that's more impressive that we didn't get the rate cuts and the market is moving, I would say, more on fundamentals. Earnings were good this quarter, so right. Maybe it's better that we're not just constantly relying on rate cuts.
It's kind of segmented. They keep taking up the numbers for the S&P 500 on the forecast. You're looking at 11%. Maybe for the end of this year. You've seen 2 quarters of growth finally, which is not what was expected a year ago, much less to today. As we were talking before, it's still a data-dependent Fed, which they've always said that they will be and continue to be, and it would be a bumpy road to the 2% inflation mark, and it is. The question then comes down to where is the money flowing into, and generally it's been the FANG-ish stocks of where they've been going into. NVIDIA, anything AI has been gangbusters. And whenever they have a hiccup, at the $2 trillion, $3 trillion market cap, you're down 1%, that's going to shake out the markets. But what's nice to see is that you're starting to see some of the other indices start to catch up. The mid-cap, S&P mid-cap 400 made a new high the other day. It's showing that it's starting to broaden a little bit as opposed to be concentrated in just to the large cap names that are the tech drivers that we talk about on almost every segment on whatever network you're on.
So one of the interesting things that we've been able to observe at State Street, we have access to what we call our investor behavior indicators. It's based on our custodial data. It really looks at what real money is doing. And there was a notable shift right around the middle of January into a much more risk-seeking type of environment. They had, for the most part, real money, which are mutual funds, pension funds, insurance companies, had been pretty hesitant to jump into this risk rally for the better part of last year and even into the beginning of this year. It was when those cuts started to become more realistic that valuations made more sense to them. And we are seeing a little bit of a broadening out in that risk-taking beyond just the equity side of things. There is more interest in high yield. There is more interest in maybe some of the commodity FX currencies that we look at from kind of that broader risk-seeking kind of environment. So, there may be legs to this, particularly if this real money momentum continues.
We're also seeing some of that within the fixed income markets, right? If you look at high yield and some of the riskier portions of fixed income, they've held up really well, even as Treasury yields have risen. And I think that the tipping point in mid-January is something that makes sense, because I think that that's where markets came to the realization that, okay, maybe we wouldn't get the aggressive rate cuts, but the economy was still going to be okay, right? If you're still having this sort of a soft landing, then it doesn't really matter, frankly, whether the first rate cut comes in May or in June or in July. Unless you're a very short-term fixed income trader, who cares, right? The broader point is, if the economy has a hiccup, the Fed's got your back. The Fed put is in. The downside risks to the economy are more limited, and in that environment, why wouldn't you become a little bit more risk-seeking, particularly if you have what looks like a more reasonable chance and a reasonable path for rates priced in.
And I think when you kind of, when you look at how, let's say some bellwether relationships in the market, I'm thinking about the curve. Everyone looks at this inverted curve and, they really think about the negative aspects of it, but the fact that we're this late in the cycle and we still have this inverted curve, not terribly inverted, so it's not hurting banks terribly badly, but it's a sign that any discussion of recession is not out there at this point. There's no reason to rally the 2-year aggressively unless you think all of a sudden you're going to wind up with 100, 150 basis points of cuts because a recession is coming. So there are positive signs kind of throughout, and there are a lot of those types of relationships that are out there.
Yeah,
I agree with all of that, but being on the equity side of things here, you look at really short term, as we mentioned before. Granted, you want to look at the longer term picture, and credit definitely falls into that. But on the shorter term cycle, you have that FOMO, and there's no more TINA anymore right now. I mean, especially when you get a 5% risk-free
there are
rate.
a lot of alternatives for the first time in a while.
I mean, look at Bitcoin making all-time highs just recently. I mean, you talk about very aggressive alternatives. So, the Fed's very confident that the disinflation narrative is going to play itself out, right? And they're very confident the consumer is going to carry this through. You look at a couple of the hiccups along the way. Unemployment's starting to pick up a little bit, but not bad. We printed at 3.9%. We've been below 4% for better part of 2 years now. Next Friday's data, if it comes out above 4% and wages start to decline, is that another hiccup they're going to look at, or are they going to push back, a 70% chance of a rate cut in June?
I'm actually not sure how confident they are.
Yeah.
But they're going to cut anyway, which is probably a massive tailwind for the market because we're going to have the Fed, the BOE, the ECB joining the SMB. I mean, we've got hundreds of basis points of rate cuts in the next 12 months.
And I take your point. I think it's a good one. It's not necessarily that the Fed is entirely confident that inflation will fall. It's that they can afford to be patient about how long it takes for it to fall. Inflation expectations are well anchored, and so if they're confident that inflation will be back at target in 2026 or 2027, that's good enough, right? That they think with a longer time horizon than the market does. They don't need to get inflation to 2% this year. If you look at their own forecast, they don't expect to. And to your point, they're planning to cut anyway, right? Because they have this long-term time horizon, because they think that they can wait for it to play out, and along the way they can normalize interest rates.
Well, Marvin, if we see the other central banks follow in suit, are there opportunities ex-U.S.? I mean, the U.S. market has been the place to be. Are you looking at other regions where there are opportunities outside of the U.S.?
I mean, certainly. So I sit very closely attached to an FX trading desk. So there are interest rate disparities that are going to emerge. There's cutting from positions of strength versus cutting from positions of weakness, and I think those stories are playing out. Overall right now, volatility is incredibly low, so you get this kind of carry environment. I think that's what's pushing the yen to a certain degree to kind of all-time lows. So there are those type of trades, but hey, it's the markets. There's always opportunities.
Right.
So look, we have very high confidence that the ECB is going to cut rates in June, irrespective of whether the Fed does or doesn't. The Bank of England has moved closer to a rate cut. Even central banks like Australia and New Zealand that came into this year saying, no way we're going to cut rates, are now saying, well, maybe we're going to cut rates. Right. So we look at that environment and look at the U.S. economy as likely to outperform from a growth perspective these other markets, and you think from an FX perspective that should give the dollar a little bit of a tailwind, right? Because you're going to have this carry story, the yield differential story, economic outperformance, and a central bank that maybe is moving a little bit slower.
Yeah. Well, we get a key piece of data out on Friday, although all of the markets are closed. We get PCE. I mean, does that really make a difference, or does it perhaps, if we get away from that micro short-term thinking, that if it is a shocking number one way or the other, we've had the weekend to sort of think this through?
I think it would have to be a shocking number to make a difference anyway. Remember that we've already measured inflation for the month, right? We got the CPI number. This is just a second way of measuring the same thing, right? So when you measure it twice, it doesn't change the you're still the same height you are no matter which measuring stick you use. So it would take, I think, something truly shocking for it to move the market. That said, it does inject some uncertainty that this is coming out on a Friday when no one's going to be at their desks or in the office. I would like to think that that gives the market the weekend to digest it along with their food and sort of figure out what it means and react, maybe in a calmer fashion. But we'll see. It's unusual to have a data point come out when no one can do anything about it.
I mean, on the trading side of things, we're looking at lighter volumes this week across the board, kind of like a very narrow range. We were talking before about the micro caps and small caps kind of outperforming today, but even if they're up 1.5%, 2%, doesn't really make one day doesn't make a trend. So, will the trend continue once this month end happens? I mean, trading volumes for the year have been averaging about 11.6 billion equity here in the U.S. This week we're averaging barely 10, which makes sense coming into a holiday shortened week. And then it'll probably continue with that on Monday, regardless of what happens on Friday's announcement. And then carrying that through. So earnings are relatively winding down for the most part. We have Walgreens tomorrow, which is the last of it. And then you have banks picking up. So now you're going to have a void where everyone's going to be hyper-focused on the macro and whatever the Fed speak brings. But it seems like they're saying the same story. They're all in line together right now, which is a rarity sometimes from what we've seen over the past year and a half, which is nice to see. I think we're flat. The equity is over the next week.
This week too, so
people have
that could explain why there's some light volume.
Something else to entertain everything. But the markets have had a good run. You know, you're up 8-9% in the majors. You're up 2 to 3% in the smaller indexes. It's a better start than people thought.
8 to 9%, and tomorrow's the last day of the quarter. I mean, that's extraordinary.
It's extraordinary. So it's better than people expected, but last year was better than people expected too. So as we said before, take the model, throw it out, and see what's up there. The only one who seemed to get it right, like you said this before, is the Fed.
Yeah. Well, I mean, we also had a different narrative last year as well. Again, moving away so much from being hyper-focused on the macro and on the Fed, we had the AI narrative come out, right? So it was something else for the market to focus on versus just what's happening in the vacuum of macro.
That's a crowded trade too, right? Now.
Well, that's the whole thing.
Yeah.
Do you start stepping back from that momentum and look into other areas?
You never walk away from that trade till it starts to fail. You know that. Being an equity guy, you just kind of run it until it goes. There's a lot there. And it's nice to see, as we mentioned earlier, the broader tail of the index is starting to catch up with that. I'm not really sure if that's going to be a big do this year. People starting to change out of that. But we do have the election coming up. The macros are going to be very out the window for the most part in that once the rhetoric and the mudslinging starts to take place. We
have 67 global elections this year.
That's something like 2/3 of the world's population
Right.
goes to the polls. And we've already seen electoral surprises that have mattered. Pakistan being the most obvious example, but these are elections that are going to matter, and so it's something we can't ignore as the year progresses. That said, history tells you that markets will always overestimate the impact that the election has, right? If you look at the actual performance of equity indices in election years, it isn't statistically different than in any other year. If you look at it relative to different Republican versus Democrat, it isn't statistically different from one to another. So I suspect and I hope that we're going to spend a lot more time talking about this beforehand than we are afterwards, right? Because afterwards you would like to think that the economy is more resilient and markets are more resilient than that.
I think the market's also struggling with the fact that there really hasn't been policy presented, so it doesn't know what's going to be good for some areas of the economy and what's not. I don't know if I'm not quite sure it's too soon, but that just hasn't been presented yet, and I think in a organized fashion, so it's kind of hard to discern where it's going to hurt, where it's going to help other areas, and of course it's anyone's guess, but I feel like the market's really waiting on some direction.
Yeah, I mean, for sure, it does appear as it's going to be close. I do think that there's going to be election fatigue, so maybe people don't want to deal with it now.
Yeah.
I'll say that some of the travels that I've had internationally recently, they're really focused on our elections.
Oh yeah.
To the point
Much more than people hear.
Yes,
Right? It's really interesting.
Much more. It's fascinating to actually see, and maybe it's because when you travel into Latin America, they're worried about the potential friction that occurred the last time, and they're certainly thinking about their local economies too. But yeah, everyone outside of the U.S. is really hyper focused on it. It's fascinating.
I think in general, my experience has been it's not even just focused on the election, but just kind of what's happening at the social moment that we're in right now in the U.S. I mean, particularly when I travel to Asia, it's kind of like what's happening there. So it extends beyond politics. I mean, it really is fascinating.
There's a lot of confusion, and most people in the world have become adjusted to a world order in which the U.S. has sort of been the North Star, and there is some question overseas in particular about whether that's something that will be sustainable, whether that's where things are going to be 5, 10, 15, 50 years from now. Yeah. Again, I don't know that any one election makes that determination, but I think you're exactly right that those broader questions are circulating and increasing attention on our politics from outside our borders.
Yeah, I mean, you've also heard some rhetoric around de-dollarization. I mean, whoever would have thought that we would have that conversation as much as we are right now with perhaps maybe the U.S. dollar won't be the reserve currency. I mean, of course, it's the largest market, it's most liquid. We understand, the reasons why it is, but de-dollarization kind of pops up in these conversations too.
It does. I'm not in that camp though.
Neither am I, but I'm just saying I didn't think at this point we'd be speaking about that.
Right? There is no alternative.
There is no.
It's easy enough.
I think from a trade perspective.
No, it's easy enough to poke holes in the dollar and say why you might want to diversify, but then you have to find something else that you're comfortable buying. And for reserve managers in particular, there's just nothing else that fits the bill.
No,
Exactly.
Yeah, well, I mean, even from, it would just upset the entire global trade apple cart. Yeah,
I think you just said it right there. Upset the global trade apple cart, right? I mean, like you said, where else would you go? There's nothing else that's better. There's nothing else proven. There's nothing else consistent. There's nothing else with the backing of this capital market structure here.
I mean, certainly the euro has its blemishes. We kind of look at how their economy is and the disparity between their, between their countries, and then the renminbi. China certainly would like to rise to the occasion, but the problems with China are pretty well defined right now.
Yeah, well, it's going to be a curious
real estate, everything. I mean, it's just politics on top of it. It's tough.
Yeah. Well, I mean, to wrap things up here, is this the new normal, the interest rates environment that we're in, the housing market that we're in. I mean, we got so used to interest rates at virtually nothing and so much liquidity in the system. Perhaps this is the new normal. If you look at mortgage rates from a historical perspective, we're right in line. So,
yeah, look, certainly our expectation is that interest rates this cycle will settle higher than they have in the past. That's a good thing, right? You know, having interest rates that are persistently low, policy interest rates, mean that the next time there's a shock that pushes the economy toward a recession, the Fed doesn't have a lot of room to ease to support it. It's a lot easier to ease to support the economy when you're starting from somewhat higher rates. We think they'll come down from here, but we're looking at a terminal rate this cycle of somewhere 3.5, which is higher than what many have become accustomed to, and that probably applies out the curve. So in that sense, you know, we are seeing things that look, I don't know that they feel normal yet, but they may in a few years.
yeah, all right.
So if I could just add a quick thought to that, you know, certainly, you know, higher yields do represent a certain normalization of the economy relative to what we've seen. Thinking about it via the debt, however, and debt levels, and whether or not the government can afford higher yields is something that I think becomes a real big story, because the interest component of debt, if interest rates come down, is staggering. If it's actually 100 basis points above, you know, like a 5, the numbers that I calculated, a 5% 10-year, for instance, not outside of the realm of possibility. The U.S. is looking at servicing $2 trillion worth of debt in the next 7 years. That's
a lot of money.
That's a lot of money.
It has to come from somewhere.
Yeah.
Indeed.
Appreciate the insight as always, gentlemen. Thanks for joining us on Trade Talks. Thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.